Want to welcome back to the videos for factoring. This one's going to cover the notes receivables, and we're going to get a note from a customer, and then we're going to sell it at a discounted rate. So on March 1st of 2016, Casino Incorporated received a 10,000 8% 180-day note. On May 12th, the casino sold the note to the First Bank with recourse at a discounted rate of 10%. And a recourse liability was determined to be $750. So the first thing we need to do is actually determine how many days we've held the note. So in March, March has 31 days, so we held it for 30. April, we held it for 30. In May, we had it for 12. So if we add these up, that will give you then a total of 72 days. Okay. So the first thing we have to do, we know how we had it for 72 days, but the first thing we have to do is determine the maturity value of the note. Now we're going to assume a 365-day note, but if you have a textbook that uses 360, change your my 365 to 360 and you'll be just fine. Okay. The first one here is the equation that I'm going to use. Now for this one, I want to use a round function. So, because I need everything to the nearest penny. So we have, I'll just type the formula in here. So we have $10,000 and it's at 8% because remember it's principal times rate times time. Then times 180 divided by 365 and then comma 2 for 2 decimal places and then close. So that'll be the formula. And what I can do then is just copy the formula down here and get rid of the parenthesis and equal sign, and it gives you 394.52. Okay, so that's what you're going to collect if you keep the note for the 180 days. So you actually get $10,394.52. Okay, because the maturity value then would be this plus the 10,000. So the maturity value is that plus the 10,000 or 10,003. That's the maturity value. I'll put that up here. MATURITY value. Because this is the face value, so that'll help a little bit in the near future. Now we have to find out what's the discount amount. For the discount then, we would have the round function again. This time we want to use the 10,394.52 times the discount rate was 10%. That was given. And we take that times the 180 minus the 72 because we find out how many days did they have to hold it. And they divide that by 365. Oh, I got some, gotta get the commas in here. Because I need actually 2 there, and that takes care of that, and I need another parenthesis right here, and then 365, comma 2. See if I got these right. I have no idea. We'll find out. Copy, paste, equal sign. Hey, it worked. I did have them right. Okay, so there's the formula. What we did, we took the maturity value of 10,394.52 times the discount rate of 10% times the number of days the bank has to hold it divided by 365. And that bank then will discount rate that would be 307.56 is what they would charge. So the amount received from the bank will be the 10,394.52 minus the 307.56. Okay, if we did that over here, then we'd have this amount minus the 307.56, or we received $10,086.96. Okay, that's the amount you'll receive from the bank. That's step 3. Step 4 is find the amount earned by the original company before the sale. Okay, so this is the 72 days that we held it. So we have the round function and the $10,000. We charged 8%, and we had it 72 divided by 365, comma 2. Now remember what I said, if you use 360, just simply substitute it for the 360. So they're going to charge us $157.81 for the interest earned. That's what we earned. So not what was charged. That's what we earned. So the 72 days we held it, we had it for we earned $157.81. Okay. Now determine the loss on the sale. The amount received from the bank is the maturity value. No, you're getting this amount. That's what you're receiving from the bank. The face value was for $10,000. The interest you earned was $157.81. We just calculated. Okay, so this is equal to, which is it's going to be a minus $10,157.81, because we're going to subtract these two and find out what our loss is. The recourse liability was a minus $750. So the amount that we'll end up losing is equal, fast way of doing that would be to do the summation. And you want a summation of all those numbers. So we're going to lose $820.85. That's the loss in the sale of receivables. And then the step 6 is to do the journal entries. So the cash you received was the $10,086.96. And then you have a loss on sale of receivables. And that's the $820.85. You just, whoops, not quite that much. $820.85. Okay, is your loss. Then you credit the notes receivable. That's for the face value of $10,000. You have the interest income. This is the amount that you made while you held it, which is $157.81. And then you have recourse liability. And this is the case they don't pay, and that's for the $750. Okay. If they pay the note, then you'll debit the recourse liability and credit your loss on receivables, because that will reduce your loss by $750. If they don't, if the note's dishonored, and the bank, because they dishonored the note, the bank's going to charge you an extra $20 service fee. Okay, so you would debit the recourse liability for the $750, and then you debit the notes receivable dishonored, and that will be for the face value of what the bank should have received, with the maturity value of this one, minus the $750. Okay, the reason why you subtract off, you already wrote off this $750. That was under the loss on the receivable. So if they dishonored it, you just go ahead and write it off again. And then the cash amount that you have to pay the bank is going to be the $10,000 plus the 10,000 times the 8% times the 180 divided by 365 plus the $20 service fee, which is basically what they're saying is that it's the maturity value plus the $20 minus, yeah, okay, those two added up that you have. But to calculate it out, to make sure it works, you have equal. I'll use round function just to be safe. Okay, the number is 10,000 plus 10,000 times 0.08 times 180 divided by 365 plus 20. Whoops, I forgot. I need a comma plus 20 comma 2 because I used the round function. Oh, now what? Oh, yes. Got the comma on the outside. Okay, so that gives you $10,414.52. That's the amount of cash you have to pay. Okay, this is a with recourse. If you do it without recourse, it's done the same as the accounts receivable. The difference would be you won't have the accounts receivable. You won't have the recourse liability. You won't have the loss. Will be the factoring expense again, like we had before, and of course it's going to be a little larger. Okay, but otherwise it's done the same way. So I hope this helps a little bit for the receivable, the notes receivables anyway. And I guess that's it for now. I hope that helped.